Dimensional has always been associated with low cost, but value investing in general. And I wonder if you could comment on what's been going on this year. What we've seen is, for the first time in a long time, for many years, 6, 7 years, value has outperformed growth. Small caps have outperformed big caps, and small cap value has outperformed everything. This hasn't happened in a long time. Growth is generally outperforming rather notably. Why is this happening? Do you think it's going to continue? Obviously, I'm sure you're happy about that, but just comment on what we've been seeing this year.
Yeah, a couple of high-level comments come to mind, Bob. First off, when you think about small and value, there's a reason those stocks have lower prices and investors demand higher returns in terms of holding them. So every day when we come into the office, we expect a positive small and value premium. And we've certainly seen that in spades over the course of the year. Even if you go back 12 months, Bob, and you look at Fama French, large growth versus small value, kind of a very pure, I guess I call it, definition of large growth and small value. The return differential is almost 60 percentage points. So a really big return difference, and something we expect a positive premium, but not always that large. The other thing I'd put out there that I think is important is that when you look at the volatility that we've had over the past few years, it highlights the importance of the financial professional in keeping you disciplined, and a money manager who stays focused on the asset category. Those two in combination make a powerful combination for the end investor. We're fully committed to the financial professional, and we think that these new, the ETF conversion will give them more tools to help manage for their clients. And we stay focused on those asset categories so that when those big returns show up, we're there to capture them. And I think that that's something that we've seen year to date and over the past 12 months.
Dave, weigh in on this. I just put up a board of growth versus value in the last 6 years, and it's a notable outperformance by growth. Why are investors paying so much money for growth in the last few years over value? This year, we're seeing a little bit of a mean reversion, as Gerard mentions. But your read on what an investor is supposed to take away from the last 5 or 6 years of growth outperformance?
Yeah, I think a lot of it has been flow driven, right, Bob? I mean, we've seen the flows that have come into cap weighted traditional ETFs. That has a quality of making the large cap market look very momentum-y. We already know that a lot of the growth companies have historically been at the top of the cap spectrum really since the dot-com era. So there's a bit of a winner take all scenario here. Interestingly, the flip that we've seen where some of the small cap or mid cap value plays have started to catch investor attention means a lot of those individual stocks are now showing up in momentum ETFs and funds. That's going to really change the dynamics here. I don't think we talk about value momentum all that often, but if you look at some of the bigger traditional momentum funds, that's what you're seeing. So I think we are in a bit of a rotation. A lot of it's because there's a no alternative market, right? Investors and advisors are really sticking to the equity markets. They don't want to move into bonds. That means they're looking a little bit away from some of these large cap go growth companies like the Teslas and Amazons of the world, down the cap spectrum into mid and small caps, into a little bit more traditionally valued companies, even a little like for dividends. So I think that's a bit of a risk-off rotation while staying in equity, which is a bit of an oxymoron, right? We don't talk about small cap being a risk-off rotation, but I think that's some of what we're seeing.
Yeah, Gerard, we are seeing the rather bizarre spectacle. I think we talked about this on the phone last week about GameStop and AMC are in the Russell 2000 value index. And of course, they've completely blown up in the last year. I don't know, they're certainly not value stocks. They won't be anymore. But you do have that rather strange situation. I just want to go back to this growth thing, because this is the thing the investors really keep hitting me on and asking me about how much longer is growth going to outperform. But why is the question, and a lot of comments I get around the Federal Reserve, that there really is a Fed put, that growth is hard to come by. The Fed has made it very easy, essentially, to own riskier assets because there is a Fed put, because they're out there buying constantly. Is that, Gerard, isn't that a factor? I know you can't say, oh, we're up 200% since 2009 because, half of it's because of the Federal Reserve. You can't quantify it, but isn't there something to be said about the Fed helping out the whole market, and particularly the growth market?
Bob, I think the Fed is certainly one market player and one market participant among many. And I think one question that's an important question for the investor is, should you expect large growth to be a 20% asset category? And if you look back over the 10 years ending last June, and you were looking at large growth in the US, it was about 20% returns, when its long pull return had been around 10%. So I think that the takeaway that I would take from that is that some of those returns were largely unexpected. And that's important to keep in mind, because when you're investing based on expectation. And if something is unexpected, it doesn't mean that the expected return of growth stocks going forward is 20%. It means they got unexpectedly lucky or unexpectedly good windfall, which may be because of the Fed or maybe because of other reasons. So I think that's really an important takeaway, Bob, when you look at the past data. Do you think large growth is a 20% asset category? And most people would say probably no. When you look at small value, does it return to its long-run average returns, which are more in the 14, 15% asset category? I think most people would say, yeah, that's plausible, given the types of stocks that you have in small value portfolios.
Yeah, Dave, you're more willing to sort of stick your neck out on these things. Is it fair to say that the growth has been helped by the Federal Reserve? I keep pounding on this, but it's the thing investors keep asking me. And what happens if the Fed withdraws that liquidity? Does that mean that growth no longer will outperform?
Yeah, I mean, it's a combo platter, right? Yes, we have the sort of the Fed put, if you will, but at the same time, we have a bond market that's really unattractive. And I think we have to look at that. And with that unattractive bond market, that means people are making blanket allocations to equities. When they do that, they tend to use cap-weighted large cap indexes, very cheap beta. What that has a tendency to do is really reinforce this winner-take-all market, and it pushes those large cap growth companies even higher. And I don't really see a way that unwinds unless we start getting a lot of really thoughtful reallocation. And honestly, we haven't seen that kind of thoughtful reallocation, right? So there is this endless bid in the market that I think is hard to get away from.